Let's get in Pranjul Bhandari. She's Chief India Economist with HSBC. Pranjul, good morning. Good to have you with us here. Thanks very much. Prashant this side.
Good morning.
What's your, I got your note here dated the 2nd of June, and you're talking about monsoon rains. But what you're saying is that that early showers, early onset is important rather than, aggregate numbers, right? The latest data that we have from the beginning of June shows that rains are about, 80% deficient already. But this period is about only 4% of total rainfall, so I guess people are ignoring it. But, the start itself is kind of weak. Let's just tackle this first. What's your assessment and what's your view?
Yeah, sure. Thanks for having me here today. Just taking a step back, food prices is really important at this point. We've had the CPI print, we've had the WPI print over the last couple of days. Both have been much higher than expected. Remember, food is 45% of the CPI basket. That's direct, and it has an even more impact through the indirect channel as well, through inflation expectations. So food is a really big deal for RBI to meet its 5% inflation target, which it has for early 2017. Now, we've looked at this whole food debate very carefully. There is a lot of skepticism. Do rains really impact food prices or not? And that's a fair question, because if you look at any long-term correlation, you'll see that it's no significant result. In fact, the sign is the wrong sign. It almost seems like rains never really impact food inflation. But, we try to look at it a little more carefully, before we dismiss rains altogether. And we found that rains impact reservoir levels, and reservoir levels impact food inflation. Now, reservoir levels are a very important thing because they are a proxy of the amount of moisture there is in the soil, and therefore, how much water will aid growth of crops. And reservoirs on their own depend not only on rains which are going to happen, over June and July, but they also depend on carryover levels of water from previous rain episodes, which sometimes becomes very important. Last year, remember, we had non-seasonal rains in February and March, and the reservoirs were much in surplus, despite, June, July being very, very deficient months. This time, however, things are a problem. We are starting the season with a deficit in our reservoirs. Reservoir capacity right now is at 17%. Last year, same time, it was at 27%. So we're starting with a negative in our reservoirs. And that's why June and July rains are really important, because they are going to be important for filling the reservoirs to normal levels. And that's why, you're right in saying that I worry a little bit that so far into the season, rains haven't been very good. But if they pick up over the next fortnight, over the second half of June, and they are very strong over July, then, they can actually lift the reservoir levels to normal. But at this point, of course, that's a hope. But we also find that if rains do really pick up in June and July and reservoirs go up to normal, that can really help bringing the food inflation rise that we've seen over the last week, that come down by a big amount.
You said reservoir levels are 17%, which means that they're 17% full right now compared to 27% same time last year.
That's correct, yes.
Okay. Fair enough. The recent inflation numbers, food inflation numbers, which showed a spike, what did you make of it, Pranjul?
Yeah, so it was mostly food related, and in food, almost all the important items showed an increase, pulses, sugar, egg, meat and fish, and so on, and vegetables most importantly. Everything showed an increase. The reasons are a couple. Number one, we've had drought for 2 years. Second, we've had severe heat waves over the last month, which has spoiled sensitive crops like tomatoes. Third, domestic transportation costs have gone up. Remember, from the start of the year, diesel prices are up 15%. These are domestic diesel prices. So all of this has sort of come together and has created this sort of not a very exciting mix for food food inflation at this point. So this was not surprising. On the other hand, core inflation also remains quite sticky. It's been sticky at 5.5% level for the last 20 odd months. So it's not really gone down despite India having a negative output gap at this point. So things are looking a little tricky for inflation at this point. But we take a step back and we try to model very carefully what really matters for food inflation. I'm narrowing down on food inflation because, as I mentioned before, that's 45% of the CPI weight and a huge determinant of what happens to overall prices. We try to model what really impacts. And there are three things that impact food prices in India. Number one is international commodity prices. Number two is domestic support prices, like the minimum support price that we have. And third is the reservoir levels. Now that we have shortlisted these three, we are finding a very interesting tug of play out there. International commodity prices are on the rise. But on the other hand, domestic, minimum support prices are not on the rise. They have been kept benign. They've been kept under 5%. So really the main deciding factor again is going to be reservoir levels, and is again going to be, the rains that we get over June and July. So this time around, rains matter much more than they mattered last year. Remember last year, monsoons weren't great, but we had a surplus in our reservoirs. This time we are starting with a deficit in our reservoirs. So this time the early rains really matter.
The sort of last, year and a half or so, data for consumer non-durables has been kind of weak. Consumer durables numbers have been, relatively stronger. I mean, you can look at that number from the IIP or whatever. And that again kind of tells you the urban-rural divide, right? I mean, urban consumption seems to be relatively more buoyant. In rural India, things seem to be pretty depressed. Would you agree, Pranjul? And again, that's why we are kind of focused on rains. From a market perspective, there's the human angle, social perspective.
Yeah, that's completely right.
Yeah, go on, sorry.
No, you're completely right. If there's, there are so many things which are confounding in India's data. But if there's one or two things clear, it is that, we're really seeing this urban-rural consumption divide. Urban consumption has been, inching up, has been fairly strong over the last couple of months especially. Urban Indians have benefited from inflation falling so much, oil prices being low, and nominal wages, sort of inching up slowly. So the urban purchasing power has gone up. On the other hand, rural purchasing power has been extremely weak. 2 years of drought, low production, low demand for labor, and therefore low wages, and therefore, low consumption. So this is one thing that is really, that stands out very clearly. But, if monsoons are good again in the June and July seasons, which is the sowing season, and it matters a lot for food production, then demand for labor could go up, and therefore wages, might go up, and that could increase consumption in rural India. But at this point, it remains a hope. Let's see how rains pan out over the next fortnight or so. But since you've come to the growth point, generally it's very difficult to get a good reading on growth at this point. For every indicator that you tell me which is doing well, for example, electricity production, for example, cement demand, couple of months ago, or some other, I can actually, name you a couple which are not doing well. For example, non-oil, non-gold imports, like we're seeing in IP data, manufacturing, PMI, services PMI. So, growth continues to remain confounding. It continues to remain wobbly. But there are about 3 or 4 messages that are very clear. The first message is the rural-urban consumption divide. Urban is doing well, rural is not doing well. The second is the public-private investment. Public investment has seen a meaningful increase. Private investment has not seen a meaningful increase. In fact, we've done a very interesting study here. We know overall investment growth last year was 4%. We've tried to break this down into public and private. And we find that private investment was minus 1% year on year, and public investment was 20% year on year. So that's this huge, public-private investment divide. And the third point is on services. We are seeing financial services to be very weak, but on the other hand, we are seeing transportation services to be fairly strong. Things like air passengers, freight in railways, also diesel consumption, all of that has been fairly strong, but, financial services, which is, bank credit, bank deposit, and so on, have been very weak. So, for every one good thing, there is one thing which continues to remain weak.
Yeah. But even things which have been strong, power consumption, right? Power generation, rather. First 4 months till April this year, growth was about 11% or so on an average. In the month of May, that has come in at under 5%. You look at cement production. January, February, March, growth was about 12% or so. This month, it's fallen to about 4.5%. The last data we have is for the month of April. Two-wheeler sales, strong growth February through April. In May, about 10% or so. So even things which kind of were doing well, they've also started to taper off quite a bit more recently. Pranjul.
Yeah, well, look, I hear you that, and that's exactly my point, that things are wobbly. But, I'll also sound a word of caution here that, just looking at monthly data can be a little confusing. A very easy way to sort of, read through the noise to take a 3-month moving average, or to see a quarterly growth, or a sequential growth or something like that. Because if you look at month on month every time, then it can get quite volatile. But, your point is completely right here that, things are wobbly. Like, some things look good sometimes, other things look good at other times, and, some things look bad, other things look bad at other times. So it is a pretty wobbly picture that we're seeing at this point. And that's why you had so many people who were skeptical, when CSO announced that GDP growth in the last quarter was 7.9%, that we've come close to the 8% mark, which is our long cherished dream.
Yeah. By the way, where do you stand, on the numbers? Because it seemed that private consumption soared and was booming, was through the roof. And that, because everything else kind of pretty much took away from the numbers. It was only private consumption which added to it. Responsible almost in whole for the very strong, near 8% real GDP growth numbers, right? Make of it is even private consumption that strong.
Look, I'm very happy you've asked me about GDP.
Yeah, sorry.
Yeah, to answer your question directly, there has been a lot of skepticism about the 7.9% number by people who are saying that the value added by discrepancies was abnormally high last quarter, and therefore these numbers are not good. There are a lot of problems with the GDP data, but I will not really buy the discrepancies point, because the way the CSO calculates its data, it calculates it much more accurately on the production side, which is agriculture plus industry plus services. They add these three together, they get the amount of GDP, and then they try to come on the expenditure side, which is consumption, investment, and net exports, and they try to distribute this number to the three categories. Now, they do a fairly good job on the production side. This is how the data has been for the last couple of decades, but they don't do a great job on the expenditure side. And what they're not able to map to the different components, they put in a bin called discrepancies, which, over time, over the next 2 years or so, in the subsequent revisions that they do, they take it out from the bin and map it into, its consumption or investment component. So I won't really go into there, because that has always been an area where India's GDP is not very strong, but it is fairly strong on the production side, where CSO adds up agriculture, industry, and services. My main problem with GDP is therefore not discrepancies, it's something else. My real problem is the way CSO calculates its deflators. Now, if you look at nominal GDP, it matches quite well with the old GDP data, both in level terms and both in, year-on-year growth terms. And that's where, I don't really have a major problem. The problem is when they try to calculate the GDP deflator and basically try to move from nominal GDP to real GDP. That's where, I suspect, and I've looked into this very carefully, the CSO over the last 1.5 years has been severely underestimating GDP deflator and therefore overestimating real GDP growth. There are two problems here. One is on the manufacturing side. On the manufacturing side, for instance, for the last year, FY16, growth was about 9.5%. That seems really high. It's really not, when you think about IP, which was closer to 2%, you really see a huge disconnect here. Now, I've looked at this very carefully, and again, it comes down to deflators. Now, what CSO does is that it does something called single deflation, whereas it should be doing something called double deflation. In the past, this did not create a problem, but over the last 6 quarters, it's created a huge problem, because for the first time, we are seeing output prices much higher than input prices. And when output prices are much higher than input prices, then if you make the mistake of single deflation rather than double deflation, then you severely underestimate the deflator and overestimate growth. So we've actually cleaned up for this, and we've come to the conclusion that manufacturing growth is not 9.5%, it's closer to 5%. So there is an overestimation there of about 450 basis points. If you clean up for that, then real GDP will fall automatically by 80 basis points. That's one problem. The second problem is on the services deflator. They are not giving adequate weight to CPI inflation. Once they start doing that, then real GDP growth will fall by about 40 basis points. So 80 plus 40, 120 basis points. So, in my mind, GDP growth is at least about 120 bips lower than what the official numbers are.
So you're saying real GDP is about 120 basis points less than the 7.9 number which has been put out by the government, right?
That's correct, yes.
Right. But you, in terms of trend of growth, what's your perspective? Are you saying that growth is getting stronger? I mean, I'm talking about the underlying momentum.
Yeah, well, underlying momentum, in my mind, it's flat. There are things which are doing well, like urban consumption is doing well. Last year, we saw the government spend a lot on public investment, and we are now seeing, semblance of it on the ground, with the cement data. Although I agree with you, it's volatile, but we are seeing some sort of semblance of it on the ground now. Generally, growth is expected to remain flat at this point. There are some things which could pull up growth. For instance, if rains are good, rural consumption revives, that will be good. But on the other hand, there are things which are actually pulling down growth as well. There's severe, risk aversion in the banking sector, where banks are not really giving out credit as easily as they did in the past. And, when you don't give out credit as easily as you did in the past, then you don't fund enterprise. And when you don't fund enterprise, then it takes away from real GDP growth. So, we are seeing a sort of different forces at play. Monsoons could improve our fortunes, but on the other hand, the banking sector stress could continue through the year. And overall, I think, growth is going to remain flat. I think it's going to remain flat at the 7.4% level this year. I know consensus expectations are for much higher growth. And I also feel that, slowly, the consensus expectations will start to lower their numbers.
Okay. So people who use these growth numbers to build out their models, expansion plans, it's an important number, which investors also look at. What's your sense? Does it make any difference at all, this entire debate about growth, etc., or you think it does not? If you look at FDI flows, for example, that remains pretty strong. I mean, I don't know if that is, you can correlate. That is one source of money which is long term and hence may have interest in looking at, numbers like GDP, etc. Portfolio flows, of course, are a different matter. Go on, Pranjul.
Yeah. Yeah, I'm intrigued by her FDI point, and FDI definitely is very important. It's seen as the most productivity enhancing sort of inflow that a country can possibly get. So the fact that FDI inflows have gone up is very exciting for the country. But if you map where the incremental FDI is going, a lot of it is going to new businesses, startups, the digital economy, the new, the banks that we are seeing. So a lot of it is going into what I call new India rather than, the old India, which in my mind comprises of things like the physical infrastructure, some of the outdated laws and so on. So, that's an important point to know, that much of the FDI is going to new India rather than old India at this point. And, will there be an impact on growth? I think there will be. I think, the sort of products and businesses that new India is offering will add to productivity growth in the economy, and I think it will be growth enhancing over the medium term. Not really sure if it will have a direct, very quick impact over the short run. But also getting back to your earlier question that, what are really investors doing? If you're accosted with a GDP data which you don't trust, how do you make your business plans? And here, people have generally found their way around. a lot of the market looks at nominal GDP rather than real GDP. For them, the GDP is not such a big problem because, as I mentioned earlier, the nominal GDP data seems to be fairly fine. No problem there. A lot of the corporate earnings is a function of nominal GDP growth. So, equity markets look at it, and equity markets have been, doing a lot of their planning based on nominal GDP growth. Those who want to get a sense of where real GDP growth is have more and more started to look at volume indicators, things like diesel consumption, motor vehicle sales, PMI, IP, a bunch of those volume indicators. Thankfully, in our country, we have a lot of data that we can work with. So people have found their way around, their problem with the official GDP in India.
Pranjul, thank you very much for your time. It's a pleasure. Appreciate you joining in.